stock market. So, last time we said that stock is the same as share. People who own stock we call stockholders. The key to stock is that it gives you ownership. It gives you ownership. And with ownership comes certain rights, like voting. Voting rights. Stock is characterized by a residual claim. Residual claim. Residual claim means that you have a claim on income and assets after all other claims have been completely satisfied. Other claims to banks, to creditors, to the government for taxes, for salaries, to suppliers, for bills like utility, electricity, for water. So after you have paid everything, whatever is left over, we call it the residual. Owners have a claim on that residual. So that represents a residual claim. Stockholders do not have direct control. They have indirect control by voting to or voting for the board of directors. The board of directors makes all most important decisions. So all important decisions are made by the board of directors. Probably the most important of all decisions is the choice of a CEO, Chief Executive Officer, the man who will run the company. Okay. And the CEO, in turn, will choose the CFO, which is the Chief Financial Officer, responsible for all financial matters. You will also choose the second biggest man as COO, Chief Operating Officer, who will be responsible for operations. And of course, he'll be choosing all other chief officers, if there's one for accounting, if there's one for legal affairs, if there is one for research, for development. Of course, there will be a chief officer for sales, for marketing. So for every major function, the CEO will be selecting and choosing them. Now, I explained last time, well, a few lectures ago, is that more important market is the bond market. The bond market is significantly bigger. It is traded a lot more, so it has more trading volume. The bond market is much more difficult. The bond market is much more complicated. Why? One company will have only one stock, but a company may have 5 or 10 pieces of debt. It may have 10 different types of bonds. So each bond will be very different from all the others. So valuing one piece of bond is different from a second piece, from a third piece. Each requires an extraordinary amount of work. While stock, all stock is pretty much the same. The stock is used as, the stock market, the whole market is used as an economic indicator. If the stock market is doing well, this is interpreted to mean that the economy will be doing well. If the stock market is not doing well, then the economy is not doing well. In other words, it acts as a thermometer, economic thermometer. It measures the temperature of the economy. Stock may be preferred. Preferred stock. And in a preferred stock, dividend is usually fixed and is usually paid before any dividend is paid to the common stock. So, when we say simply stock and simply share, we refer what is known legally and technically as common stock. Only common stock has the residual claim. Preferred stock has a superior, higher claim to dividends. Okay, so preferred stock will have a dividend, let's say of $5 or $2 or $3 or maybe like 7%. We call it dividend yield. So dividend must be paid first on preferred stock before common stock could be getting any dividend. Now, the return to common stock is dividend. This is what an investor receives for his investment in the stock. Now, the investment in the stock is also stock. Share is also known as equity. Equity. And from the first lecture, if you remember, I'll repeat. The return on bonds is interest. The return on currencies is interest. The return on real estate is rent. And the return on stock is dividend. Okay? So, one of the most characteristics is that dividend is discretionary. Discretion lies with the board of directors. Discretionary means that the board of directors can choose to pay or choose not to pay. Can choose to pay $1 of dividend or $3 of dividend or $10 of dividend. So, dividend will be paid only if money is available. And money comes from two ways. The source of money for a corporation is two ways. Number one is internally generated. We call this profit, retained earnings. And the other source will be from borrowing from creditors. So, dividend will be paid usually when there is money. Usually corporations keep the dividend steady. They pay $2, $2, $2, $2, $2, and corporations are afraid to lower the dividend. Lowering the dividend is called a dividend cut. Dividend cut doesn't mean you cut it. Cut in the sense of lowering, reduction. A dividend cut is interpreted by the market as a very bad sign. It is interpreted as a sign that the corporation does not see very good prospects and does not see good opportunities to make profit. The opposite is also true. Raising the dividend is usually interpreted as a very good sign that the company expects in the intermediate term, the next 3 to 5 years, to have higher earnings, higher profits, higher free cash flow that will be able to pay out as dividends. So the characteristics of a company, the characteristics of a stock, maybe there are lots. For those who may be carrying a textbook with you, it's on page 220 on part number 1. Characteristics number 1 is discretionary dividend. The second characteristic is, which I explained already, residual claim. The third key characteristic is limited liability. Limited liability means that the liability of shareholders or stockholders is limited to their original investment, is basically limited to the value of their stock. They can lose at most the value of their stock, but no more than that. If there is more debt, more obligation to creditors, they are not liable. You cannot get more money out of them. So, the residual claim means if there are any profits, whatever the profits are, you can keep them all. So, the potential for profits is unlimited, but the potential for losses is limited only to your investment. If the business loses money, they can't come and get your house, they cannot come and get your car, they cannot come and get your computer or any of your assets. You lose at most only your original investment. Now, on discretionary dividend, that applies strictly to the US and a few other countries. There is what is known as double taxation. Double taxation means that whenever dividends are paid out, twice are paid taxes on them. One is called profit tax. Profit tax is usually known as corporate income tax. In other words, the business itself pays taxes on its profits before it pays out taxes. And the second one will be called income tax. And income tax will be personal income tax. So, when the investor receives the dividends, he has to pay a tax on it. So, double taxation refers to first paying tax, a corporate tax, and second time paying an individual tax or an investor income tax. Okay. Number 4 will be, I already mentioned a little bit, voting rights. Some stock will be usually voting, means has voting rights, and some stocks may have, and that will not be technically, it will be stock, but it will not be common stock, will have non-voting. This means non-voting right means they will be investors, they'll be sharing in the profit, but not in control. Voting is about control. Who controls? Who makes decisions? Okay? So, voting will provide control, and non-voting rights means that you cannot vote, you cannot control, but you still share in all the profits like the voting people. So, usually voting rights are reserved for those who originally established the company. They've made a successful company, they've proven managers or visionaries, they can make good decisions, so they'll have voting rights. And all the other investors will say, well, okay, well, if Bill Gates is running my company, I'm okay to be non-voting and to leave my voting to Bill Gates, supposedly, or to Michael Dell. Let's see what else we have. There are 2 types of voting. Probably no need. Maybe we can just define them, but there is no need to go into any detail. That type of voting depends on the law. In some countries, you will have both types of voting. In one country, depending on the law, we'll have only one type of voting. In another country, you'll have the other type of voting. But the 2 main types of voting are cumulative voting, and the other one will be just straight voting. Now let's see what's cumulative voting. Make sure we get it. Alright, so all directors for election in cumulative voting are voted on at the same time. The number of votes for each shareholder will be as many as directors are chosen. So if we need to choose 5 board of directors, each shareholder receives 5 votes. And now comes the key. I can give 1 vote to you, 1 to you, 1 to you, 1 to you, 1 to you, or I can give all of my votes, 5 votes, to 1 person only, to 1 director. So that's cumulative voting. Cumulative voting is if there are 5 directors, I can have my 5 votes to 5 different people, or I can give 5 votes to only 1 person. Because I know this person, because I trust this person. Now, with straight voting, the procedure is a little simpler. It basically means that for every board of director member, you first vote for the first member, everybody votes for the first member, count the votes. Then for the second, count the votes. Then for the third, count the votes. And you select the 5 board members which have the highest number of votes. Cumulative voting is usually good for minority shareholder. So if you're a minority shareholder and you want to choose a good, you want to choose somebody that you know, that you can trust, cumulative voting will do better for you. Why? Because if you have, let's say, 10 board of directors to choose from, you will have 10 votes, all your 10 votes to that one person. And a few other stockholders who can do the same, then they can choose their own representative on the board of directors. The board of director representative will defend their financial interests. Okay, let's see what else. Well, number 2. Apparently there is more going on with preferred stock. So, preferred stock sometimes is known as, and is called, similar to convertible bond, is called a hybrid security. Hybrid security is a financial instrument or is a security that has some characteristics of debt and some characteristics of equity. The characteristic of debt is that it has a fixed dividend. So the dividend is fixed at 6%, or the dividend is fixed similar to interest at $3 or $4. It has a characteristic of equity that if the company doesn't have money and doesn't pay the dividend, there are no devastating consequences. In other words, there is no bankruptcy. You cannot declare the company into bankruptcy. They still do have a residual claim in case of a bankruptcy. Whatever is left over to all shareholders, they will get just as much. So they do have equity characteristics. The preferred part gives you the debt characteristic. So, like a bond, it pays periodic fixed payment. Alright, now let's see, there is some stuff. There's quite a bit complicated, but we gotta go through them and see what happens. There are a number of versions. Cumulative stock. Cumulative. Cumulative preferred stock. Cumulative means that dividend, missed dividend, is accumulated. So you gotta pay $5 this quarter, but we don't have money, so we don't pay you, right? Next quarter, we don't pay you 5, now we owe you 10. And if we miss, let's say, 4 quarters of 5, it becomes $20 of dividend. It has been accumulated to preferred. Cumulative means that ordinary or common stock cannot receive any dividend at all until the cumulative preferred stock has been paid in full. So if there is a, let's say, a dividend of $7, all dividends will go to preferred stock, and if more dividends are owed, common stock will receive nothing. So all dividends must be paid only to cumulative stock until all dividends that are owed are paid, and then common stock will receive any payment. So cumulative is generally a very good, very desired feature of preferred stock, and it protects the interest of preferred stock holders. The opposite of cumulative will be, of course, non-cumulative. Non-cumulative stock means if the dividend is not paid and lost, it's lost forever. You're never going to catch up on that dividend. So they promised you $5, but if they don't pay the $5 dividend, you're not getting anything. Okay? And next time, you're going to get only 5. With cumulative, you'd be hoping next time you'd be collecting 10. And until you collect your 10, the ordinary common stockholders cannot get anything. So that's the difference between cumulative and non-cumulative. And then the other one, so these two kind of like go together, is participating and non-participating. Participating common stock, and the other one will be there's G. Now let's see what's participating. Okay. Participating common stock means that if there is more money and if there is more profit, they will participate in increased profits with an increased dividend. So the promised dividend is $5. But if there's a huge profit, maybe they'll pay and they'll participate in the profit, they'll get 7 or 8. For example, participating will be for pharmaceutical company which is developing a brand new drug, okay? And if this drug is a blockbuster, meaning it makes phenomenal profits, if you have a participating dividend stock, preferred stock, this means that if the profits turned out to be 1 billion and make huge money, your dividend can easily go up from $5 easily to $50. And it can make a ton of money, right? But if there is no profit, they'll just have to keep paying you the $5 which they promised you. So in participating, they can pay you a lot bigger dividend than they promised if they have the profits and the money to do it. In non-participating, they will not be paying you any extra dividend above and beyond what they have originally promised. This means that the dividend in non-participating is essentially fixed. At whatever has been determined. Here, you have probably studied, in participating, it acts as a call option. It acts as an option which provides upside on profits. If there are bigger profits and there may be bigger dividends, they will get a bigger dividend. So there's an upside potential here. So participating is always better than non-participating. Cumulative is always better than non-cumulative, okay? And you can have either of these, cumulative, participating, cumulative, non-participating. You have non-cumulative, participating, non-cumulative, non-participating. So we can say for sure that cumulative and participating stock is better than all the other versions, than all the other preferred stock, and it will always have a higher price than all the others. So each of these will have its own price. even though they may be just a $5 dividend. Each little characteristic can add a little extra value to your dividend. So, cumulative is considered less risky, and non-cumulative is considered more risky. More risky because if they skip the dividend, then you will not receive it forever. Okay? But again, participating is still better than non-participating, in the sense that if there are major profits, you'll get a lot more for it. Okay, let's see what else we got. When preferred stock is issued, preferred stock like common stock is beneficial for creditors. It represents additional capital in the company that can be used to pay to creditors. So creditors like to have more preferred stock because it provides more capital to pay back the creditors. Because these preferred shareholders will not get any dividend until all creditors are fully and completely paid. So this represents a capital and represents a extra protection for creditors. So creditors like to see more preferred stock, just like they like to see more common stock. Common and preferred stock we call capital is a source of protection for creditors. It reduces the risk of insolvency. All right, let's see what else we got. Okay, well, the next thing which I explained, because dividend may be skipped, but interest cannot. In general, preferred stock is considered to be riskier than bonds, riskier than credit, riskier than debt. And higher risk means that preferred stock will have to pay a higher return. So, the costliest way to finance, the most expensive way to finance a company is first to finance it with common stock. The second most costly way to finance the company is with preferred stock. The third costliest way to finance a company is with convertible bonds. And later on with debentures, and the cheapest way will be with some sort of secured bonds. That's probably coming down. You should have studied this in corporate finance a little bit, right? Well, financial management. Maybe. Okay, let's move on. Okay. Next section is, okay, we take a break now, only 5 minutes, and then we'll continue. 5-minute break.